My dear students, welcome back to our channel. In this video, I will be explaining the MBA 4th semester subject International Finance as prescribed by Osmania University and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 3 first important short question is 1. What is purchasing power parity, PPP? Answer. Purchasing power parity, PPP, is a theory that says the same product should cost the same in two different countries when prices are converted into a common currency. It helps compare the cost of living between countries and also helps in determining exchange rates. According to PPP, the exchange rate between two currencies should be such that one unit of currency buys the same basket of goods in both countries. Example. If a burger costs 200 rupees in India and $2 in the USA, then the exchange rate should be 200 rupees to dollars is equal to 100 rupee per $1 as per PPP. If the actual exchange rate is 83 rupee per $1, then India is cheaper than the USA in PPE terms. Easy trick to remember. PP is equal to same product, same price, same value in any country. Next important short question is 2. International Fisher Effect. The International Fisher Effect, IFE, explains the relationship between interest rates and exchange rates of two countries. It says, if a country has higher interest rates, its currency will weaken in the future. This is because higher interest rates mean higher inflation, which reduces the value of the currency. Example. Suppose India's interest rate is equal to 6%. USA's interest rate is equal to 2%. According to IFE, the Indian rupee will depreciate, lose value, compared to the US dollar in future. Why? Because higher interest rates in India may attract foreign investment now, but over time, inflation will rise and reduce the rupee's value. Easy to remember. High interest, high inflation, weak currency. The IFE helps investors and businesses predict currency movements and make better decisions in foreign investments or trade. So, if you see high interest rates in a country, don't assume its currency is strong forever, it may drop later due to inflation. Next important short question is 3. Greek debt crisis. The Greek debt crisis happened when Greece borrowed too much money and couldn't pay it back. This started around 2009. What happened? Greece spent more money than it earned, especially on salaries, pensions, and public projects. It borrowed from other countries and banks, but didn't manage the funds properly. When the global financial crisis hit in 2008, Greece's economy slowed down and it couldn't repay its loans. Result. Greece faced huge debt, high unemployment, and protests. European Union, EU, and International Monetary Fund, IMF, gave bailout money but asked Greece to cut spending, austerity, which made people angry. Its credit rating dropped, and the Eurozone faced a big financial risk. Easy to remember. Too much borrowing plus poor planning is equal to debt crisis. The Greek crisis teaches that countries must manage spending wisely and avoid heavy dependence on loans. Next important short question is 4. Options market hedge. An options market hedge helps companies protect themselves from currency exchange rate changes when doing international business. Let's say a company in India exports tea to the USA. They expect to receive $10,000 in 3 months. If the USD to INR rate drops, they will get fewer rupees. To avoid this risk, they use a put option. It gives them the right but not the obligation to sell dollars at a fixed rate. Example: current rate is equal to 83 rupees per USD. They buy a put option to sell at 83 rupees, paying a small fee. After 3 months, if the rate drops to 80 rupees, they use the option and still sell at 83 rupees, saving money. If the rate goes up to 85 rupees, they can ignore the option and sell at 85 rupees. Remember this trick. Options give choice, not force. Pay a fee, avoid a loss. This simple tool helps Indian companies stay safe in global trade. Next important short question is: 5. Asian currency crisis. The Asian currency crisis happened in 1997 when many Asian countries saw their currencies lose value very fast. It started in Thailand, then spread to countries like Malaysia, Indonesia, South Korea, and others. These countries had taken a lot of foreign loans in US dollars. But their own currencies, like the Thai baht, were not strong enough. When investors lost trust, they quickly pulled out their money. This caused the currencies to crash. Example: Thailand had fixed its currency to the dollar. When it couldn't maintain the rate, the baht dropped sharply. Businesses couldn't repay dollar loans, banks failed, and people lost jobs. Why remember it? It teaches that borrowing in foreign currency is risky if your own economy is weak. Fun trick to remember. Too many dollar loans, weak currency moans, crisis knocks at the door. India learned from this crisis and kept its economy more balanced and safer. Next unit 3. Long questions. First important long question is: explain the types of foreign exchange risk. When companies or individuals deal in foreign currencies, there's a risk of losing money due to exchange rate fluctuations. This is called foreign exchange risk. There are 3 main types. 1. Transaction risk. This risk happens when a company has to make or receive payments in foreign currency. Example: an Indian company sells goods to a US buyer for $10,000, payment due after 3 months. Today, $1 is equal to 83 rupees. But after 3 months, if $1 is equal to 80 rupees, the company will get fewer rupees, 80,000 rupees less. This loss is transaction risk. Tip to remember: money to come or go. Exchange rates make it high or low. 2. Translation risk. This affects companies that have foreign branches or assets. When they convert foreign accounts to Indian rupees, the value may change due to exchange rate differences. Example: a company owns a hotel in the UK. Its value is shown in British pounds. If the pound falls against the rupee, the value of the hotel in Indian books drops, even if nothing changed physically. Tip to remember: books and balance sheets feel the heat. 3. Economic risk, operating risk. This is the long-term risk that currency changes can affect a company's future profits and market value. Example: an Indian car company exports to Europe. If the euro weakens, Indian cars become expensive there. Customers may buy less, reducing profits. Tip to remember: currency changes hurt future gains. Easy way to remember all 3. Transaction hits today, translation hits reports, economic hits future way. Foreign exchange risks are common in international business, but companies can use tools like hedging to protect themselves. Understanding these risks helps businesses stay safe in a global market. Next important long question is: 2. Describe the parity theories. Parity theories. In international finance, parity theories explain the relationship between exchange rates, interest rates, and inflation between two countries. These theories help understand why currencies gain or lose value over time. Here are the main types of parity theories. 1. Purchasing power parity, PPE. This theory says, same goods should cost the same in different countries when prices are converted to a common currency. Example. If a burger costs 100 rupees in India and $2 in the USA, then the exchange rate should be 50 rupees is equal to $1. If the actual rate is 60 rupees is equal to $1, the rupee is undervalued. Over time, the rate may adjust. Easy tip. Prices decide parity. 2. Interest rate parity, IRP. This theory says, the difference in interest rates between two countries equals the difference between forward and spot exchange rates. Example. If India's interest rate is 6% and the US rate is 2%, then the rupee will likely depreciate in the forward market. This stops investors from earning easy profits by shifting money. Easy tip. Higher interest, weaker future currency. 3. International Fisher Effect, IFE. This theory links interest rates with expected inflation. It says that a country with higher interest rates will have higher inflation, leading to a weaker currency over time. Example. If India has higher interest and inflation than Japan, the rupee is expected to weaken against the yen in the long run. Easy tip. High interest, high inflation, weak currency. Summary to remember. Theory key idea tip. PPE prices determine exchange rates, prices decide parity. IRP interest rate difference is equal to forward rate difference, higher interest, weaker currency. IFE interest reflects inflation and currency value, high interest, weak rupee. Fun rhyme to remember. PPE is price, IRP is rate, IFE says inflation decides fate. These theories help students and companies understand how currency values change globally. Next important long question is 3 types of risk and risk management methods. What is risk in international finance? Risk means uncertainty about future outcomes, especially about losing money. In international finance, risks are higher due to currency changes, global markets, and political situations. Types of risk. 1. Exchange rate risk, currency risk. When a company deals in foreign currency, any change in exchange rate can cause a loss. Example, an Indian exporter gets $1,000. If the dollar falls from 80 rupee to 75 rupees, he earns less in rupees. 2. Interest rate risk. Change in interest rates can affect loan costs or investment returns. Example, if interest rates rise, a company paying interest on loans will have to pay more. 3. Credit risk. The risk that a borrower may not repay the loan. Example, an Indian bank lends to a foreign company, but the company defaults. 4. Political risk. Political instability or government rules in a foreign country can affect business. Example, a sudden export ban in another country can harm Indian companies. 5. Market risk. Risk of losses due to stock market or commodity price changes. Example, a fall in crude oil prices can affect Indian oil companies. Risk management methods. 1. Hedging. Using financial instruments like forward contracts, options, or futures to reduce risk. Example, an exporter can fix the dollar rate today for a future date using a forward contract. 2. Diversification. Don't put all your money in one place. Spread investments across different countries or sectors. Example, invest in both US and European markets. 3. Insurance. Get coverage against political or credit risk. Example, Export Credit Guarantee Corporation, ECGC, provides protection to Indian exporters. 4. Credit checks. Always verify the financial health of foreign partners before giving credit. 5. Regular monitoring. Track exchange rates, interest rates, and global news regularly to take quick action. Final tip to remember. Right tools, right moves, manage risk, improve your grooves. Always plan ahead to avoid shocks in international finance. Next important long question is: 4. Exchange rates. Can $1.317 per US dollar spot? Can $1.2950 per US dollar 6 months forward? Interest rates US $10%. Can $6%? Work out the possibilities of arbitrage gain. Given spot rate 1 US dollar is equal to 1.317 Canadian dollar. 6-month forward rate 1 US dollar is equal to 1.2950 Canadian dollar. Interest rate in US 10% per year, 5% for 6 months. Interest rate in Canada 6% per year, 3% for 6 months. Goal: check if there is an arbitrage opportunity and calculate gain. Arbitrage means earning risk-free profit by using differences in interest rates and exchange rates. Step by step. Let's assume you start with 1,000 US dollars. Step 1. Convert US dollars to Canadian dollars at spot rate. Spot rate 1 US dollar is equal to 1.317 CAD. So, 1,000 US dollars times 1.317 is equal to 1,317 Canadian dollars. Step 2. Invest the Canadian dollars at 3% for 6 months. 1,317 Canadian dollars times 1 plus 3% is equal to 1,356 Canadian dollars and 51 cents. Step 3. Convert back to US dollars using forward rate. Forward rate 1 US dollar is equal to 1.2950 CAD. So, 1,356 Canadian dollars and 51 cents divided by 1.2950 is equal to 1,047 US dollars and 71 cents. Step 4. Compare with investing in US directly. 1,000 US dollars times 1 plus 5% is equal to 1,050 US dollars. Final comparison. US direct investment 1,050 US dollars. Canadian route with arbitrage 1,047 US dollars and 71 cents. Conclusion: no arbitrage gain. Because 1,047 US dollars and 71 cents 1,050 US dollars, there is no arbitrage gain. In fact, if you convert to CAD and invest, you lose a small amount compared to keeping the money in the US. Tip to remember: buy low, sell high, only then will profit come by. In arbitrage, always compare both routes carefully, the higher return wins. Next important long question is: 5. The following details are given. Spot rate 90.60 is equal to DN1. 1 year forward 63 cents DN1. Annualized interest rate on 1 year DN is equal to 6.5%. Annualized interest rate on 1 year dollar is equal to 8.5%. Find out if there exists a possibility of arbitrage gain. Given data: spot rate 90 rupees and 60 paise is equal to 1 DN. Mark. 1 year forward rate 63 cents is equal to 1 diem. Interest rate on diem, Germany 6.5%. Interest rate on US dollar, USA 8.5%. Step 1. Check for covered interest arbitrage. We will use this formula. Theoretical forward rate, F, is equal to spot rate times 1 plus interest rate in domestic, 1 plus interest rate in foreign. Here, diem is domestic, since the exchange is quoted as diem to others. USD is foreign. Spot rate is equal to dollar per diem is equal to S is equal to unknown. Wait, we are told 90 rupees and 60 paise is equal to 1 diem and 63 cents is equal to 1 diem, so let's first find spot rate in dollar per diem. Already given in 1 year forward is equal to 63 cents per 1 diem. We need to compare this with the theoretical forward rate. Step 2. Calculate theoretical forward rate using IRP. Spot rate, dollar per diem, is equal to, let's say, S is equal to unknown, but wait, we can work backward. Let's check whether the given forward rate is equal to 63 cents per diem is higher or lower than the rate predicted by interest rate parity. Use IRP formula. F is equal to S times 1 plus I underscore domestic, 1 plus I underscore foreign. Let's solve for theoretical forward rate, assuming spot rate is equal to S is equal to $X per diem. Given I underscore diem is equal to 6.5% 0.065. I underscore dollar is equal to 8.5% 0.085. F is equal to 0.63. Using IRP, F is equal to S times 1 plus 0.065, 1 plus 0.085. S is equal to 0.63 slash 0.981 0.6423. So, theoretical spot rate is equal to $0.643 per diem. But actual spot rate, implied, is equal to 63 cents per diem. Step 3. Compare and identify arbitrage opportunity. Theoretical spot rate is equal to $0.643 per diem. Actual spot rate is equal to 63 cents per diem. This means diem is undervalued in the market compared to theory. You can buy diem cheaply now and lock in higher return. Step 4. Arbitrage strategy. Buy low, invest, sell high. 1. Borrow dollar at 8.5% interest. 2. Convert dollar to diem at spot rate. 63 cents is equal to 1 diem. 3. Invest in diem at 6.5% interest for 1 year. 4. After 1 year, convert diem back to dollar at forward rate. You'll end up with more dollars than borrowed, meaning risk-free profit, arbitrage gain. Conclusion. Yes, arbitrage gain is possible. Because actual forward rate deviates from the interest rate parity condition. Easy tip to remember. Buy in the cheaper currency, invest smartly, and convert back wisely. Always use IRP to check if profit is hiding in interest rate differences.